What's going on, guys? AK here, and of course we're going to do another market review this week, just like we do every week. Obviously this market is looking pretty strong, just like we talked about last week, but we always got to check our downside. That's why we do these videos, because things can change and you need to be ready for it. And in this case, we might actually be setting up for a bull trap going into the end of the year, and I'm going to explain exactly what that means in this video, so make sure you watch until the end. Now, as always, we're going to get into some of the research from my research firm MacroOps. Now, like I said, the action we've seen in the market lately has been pretty bullish, especially last week after the Biden win, or the contested Biden win, according to Trump, and word about a new vaccine. So our last video was actually on this day, where you see November 9th, we had a huge spike, but then it came back down and closed below the resistance point by the end of the day. And what am I talking about when I say resistance point? I'm talking about all this right here. So you can see here, this is a broadening top pattern. And basically what happens when you're looking at patterns is when it hits the top of the pattern, you expect it to fall like it just did here, and again here more recently. And when it hits the bottom of the pattern, it should spike higher. Now, why do stocks do this? Why does technical analysis even exist, which is what we're talking about? Well, really, it's just psychological levels. There's no magic here. All a price chart tells you is where people are buying and selling. And what's interesting is that people put their own psychological anchors at certain prices. So again, this isn't magic. It's just a graphical representation of what people are doing in the market with their money. And that's always the most important thing to look at. Not what people are saying, but what they're actually doing. Where are they actually putting their money? So what's happening here is that we had a close above multiple resistance points, like I was saying. First being this large broadening pattern. Second being the Bollinger Bands, which is another technical analysis indicator. We closed at the top of those. And we're above that large round number, the 3,600, which is again a psychological level that people cling to. And we're always going to be talking about people because markets are made up of people. I actually saw a comment on a previous video where I said that same thing, where they're like, AK, no, markets are made up of algos. And to that, I made a whole series about this, but who do you think makes those algorithms in the first place? People. And people, whether they like it or not, they put their biases inside of these algorithms. And when you're building some type of machine and you put a human bias inside of it, which is inevitable, what happens is that bias is amplified. So in fact, it could be even worse than if it was just a human sitting there and trading, which there still are a lot of those people. But anyway, another important thing about this close was that it's on the weekly level. So when you're looking at charts and you're looking at price action and what's going on in the market, you could look in the daily time frame, which was, every one of these bars equals 1 day. And you can also zoom out to the weekly time frame. And the reason we look at different time frames is because some give more accurate readings than others. So you can see it right here, this weekly close last week above this level right here. And that's a strong signal because people are taking their positions home over the weekend. And also another thing that can happen during the week is that you can break above a level and then just come right back down below it, just like that's happened in these candles. This one on the 31st, another one here October 12th, happens all the time. So for something to break, to say, hey, this is very bullish, you want it to actually close and stay there above that level. And that's what we got. And again, this is absolutely bullish, but also we gotta wait and see still, because it's still kind of fighting with that level, that 3,600 level. Just because we're at 3614 doesn't mean we can't fall below that level once again. But overall, things are looking pretty bullish. But as I said in the beginning of this video, there are some risks, and that's what we always need to be looking out for as investors. And one of the big potential risks is that of a bull trap, which we're about to explain right now, so keep watching. Okay, so the near-term bearish case that we're talking about, the risk that we always need to be looking for, that risk is that the market is setting up to trap the bulls on a false breakout. That's what a bull trap is. Here's an example of a style of bull trap right here that happened on that November 9th that we were talking about just now. The market shot up, and you see that's what this wick is right here, but it came collapsing back down and closed below where we thought it was breaking out. That, you could say, is a one-day bull trap, because what happens is that a lot of people see that action, right, when it's a nice full bar, say like this one right here on October 12th, all the way up here, and everyone's like, oh yeah, this bull is awesome, let's buy in. And then what happens? As soon as they're buying, they keep pushing it up until all of a sudden it reverses, and all those people who bought up here became underwater. Underwater in the sense that the shares that they bought, the price has dropped, and now they're actually negative in the red. And you can see even up until today, even though it reversed and started going higher, we still aren't at the high of that wick on the 9th. So the people who bought at the top, still underwater. And that's kind of how resistances form in the market. Again, it's psychology, because the people who bought right here at the top, which I should probably put a number to it, it's a high of 3668. Well, when price gets back up to that, those people might might want to sell because they're finally at break even. So you'll see price go up to that point and then pull back again until it finally breaks. And that's just an example of overhead resistance that keeps prices from just breaking through. Now that will be a short resistance, but the point is of this example is the bull trap. Those bulls got trapped because it fell as soon as they bought. So if you expand that past a day, you could think about the same thing happening on a larger market scale, right? So we broke these levels and maybe we run up, say we run up to 3,700, but then all of a sudden we start collapsing back into this range. It can happen. And if that does happen, that's what we would say, bull trap. All those people got screwed who bought up here. Now, do you know when a bull trap is going to happen for sure? Of course not. You can't know anything for sure in the market. We're just playing probabilities here and preparing for every potential scenario. Now, what we're talking about here, why there might be a potential bull trap, is because of this CCPV outbreak that's happening right now, the third wave. What happened? Chicago just shut down. Where I live in Michigan, if you probably heard about Whitmore, she's shutting down everything again. And yeah, a lot of people are angry about that. And I don't really have an opinion either way other than if you don't shut things down, people are absolutely going to go out and it will spread. But is that their choice? Yeah, probably. Should you force a shutdown? Maybe, to help the hospitals and stuff. I'm all for less government and less control over people, but at the same time, this will save lives. So I don't know. But regardless, that CCP narrative is coming front and center once again. So that is a good bearish scenario to cause the bull trap, because it's only going to get worse going into the winter. What, we got Thanksgiving, then we got Christmas. These grandparents are in danger. And it's especially bad in the Midwest because it actually is cold and everyone is just meeting inside now. But it's getting bad everywhere because it is getting colder everywhere. And at the current trajectory, much of the US is set to breach ICU capacity within the next 60 days. So there you have a potential bear scenario that could kill this bull rally. But we think with the vaccines and the more stimulus on the way that the market should be able to look through this. But it's a scenario that we got to look at. Because again, what have I said like 5 times in this video alone? You always got to look at your downside and manage for that. That's what good investors do. The guys only focused on the upside, they never last. They blow out eventually. They lose. The guys constantly focused on the downside. Those are the ones that win long term. And they win by surviving. And really, I think this bull trap won't occur. I think we'll keep going higher because at this point, the market should already be pricing in the worst possible COVID scenario. This isn't like new information. We know it's happening. We've seen it happening. And we even predicted before that this wave was going to come right around this holiday time. And even so, what's happening in the market? It's going up, right? So if that's the case, you may be able to say that it's all been priced in the worst case scenario and the market just doesn't care. But you never truly know because this wave might be worse than anyone is thinking. And if that's the case, then the market didn't predict it. That's when you'll get the bull trap. And this leads us into a very important concept when it comes to markets, which we're about to explain. So keep watching. So the important concept that I'm talking about is expectations. So if the market is expecting bad case scenario for COVID, okay, that's fine. The market will keep going up. But if the COVID case is worse than the market is expecting, that's the bull trap. And this is the same analysis you can use when it comes to earnings. And I'm talking about earnings of individual companies because we know that's something a lot of investors focus on, obviously. You got to know if your company that you're invested in is actually making money. But the better way to look at it is through the lens of expectations. Once again, playing the person on the other side of the stock instead of just the numbers themselves, because markets are driven by people. 7th time I said that in this video. This is great. We should have a counter. But check it out. For earnings, analysts continue to set a low hurdle for the market to clear. Into Q3 earnings, analysts expected negative 20% earnings per share. The actual result was 2%. Quarter 4, the same thing is happening. Now, why is this important? Once again, expectations. If you have a bunch of analysts and everyone expecting that these companies are going to put out abysmal earnings, negative 20%, and then they come out at actually positive 2%, well, that's incredible. Now, objectively, if you look at it, 2%, what is that? But you can't look at it objectively in a vacuum. And I shouldn't say objectively, maybe that's not the right word, but you need to look at it in comparison, again, of the expectations. If they're expecting this much and you even get this much, just a little bit more, and it's still bad all around, it's still better than what was expected. So you can expect that the stock price will continue higher because investors' expectations were not only met, but exceeded. And that's what pushes stock prices, not the fact that the company is making money or not. Because if that was the case, if a company needed to make money for its stock price to go up, what's up with all these tech stocks? They lose money for years on end. Terrible, terrible earnings, but the price keeps going up, right? So you really got to look at what the other investors are looking at. It's playing the player, playing the person. Always the smartest smartest thing to do in the market, next to risk control and looking at your downside. Now, another interesting thing that's happening in the markets is from a demographic perspective. So if you look at population growth in this chart right here on the left, you can see the retirees peaked a few years ago. But now going into 2025, people in the age range between 35 and 55 is getting a nice little peak again as the retirees just fall off. Now, why is this important to the markets, this demographic thing that's happening? And this is the number of people in these age groups, by the way. Well, it's important because the 33 to 55 age, these younger people tend to own more stocks as a percentage of their total retirement versus the 65 plus group that are closer to retirement or, retired already. They move into less risky assets because stocks are considered more risky. And when you're younger, you can put a lot more of your money into those stocks versus, say, bonds, which are safer. So if more people are falling into this age range that are going to be buying up more and more stocks as they get that money, that could be a nice push to the market. So again, this spike that we're getting in this blue line could help the bull market. And something like this, when you're looking at demographics, is very long term. So you can have a lot of dips and spikes in between there. But if you zoom out, once again, like we were talking about before, you will see the trend going up. Another interesting bullish point is that consumers are actually pretty good after this whole COVID thing. This is research from Goldman Sachs that says that households are likely to lower their forced saving rates from the pandemic, meaning they couldn't get out of their house, so they were saving a lot more money. But now as things open up, even they're trying to shut it down actually, but it might not work. They're going to spend down some of that excess savings that accumulated into the pandemic. And we expect that to trigger a mid-year consumption boom that lifts GDP growth. So you can see right here in this chart, when the CARES Act was passed, personal savings rates were really high. And you can see the same thing here. It's growing every month. Well, all this savings is going to be spent. That means people are going to go out and buy products. And what happens? That money flows to the companies that the rest of us are invested in. And that should once again show up in what we were talking about before, earnings. And if you beat earnings, the stock will go up, or it should anyway. And sorry, I shouldn't say beat earnings. I'm saying beat expectations. So expectations of those results. Another interesting thing to track that's away from stocks kind of is the commodity super cycle, which is about to pick up once again. This is once again for Goldman Sachs. They explain that in the last decade or so, there's been very little investment in commodity producing sectors. So when we're talking about commodities, think like oil. The oil space is completely shot. So even though, gas prices and oil prices collapsed during the CCPV because, no one was going outside, there's still actually a deficit in what those companies are making, meaning that they're still not making enough oil, even though all this demand collapsed. And the reason why is because of something called the capital cycle. And the capital cycle, in the most simplest terms, is companies, how they invest in future production. So if you're an oil company, are you building more rigs or not? Because more rigs and more projects mean you're going to, pump more oil for the future. So in this case, we just went through a cycle where everyone stopped investing. So we're hitting a point where demand might actually be exceeding the amount of supply that is available. And if that's the case, this is the next part of the cycle. Once again, they got to start building up their rigs. They got to start pumping more oil to meet the demand. And when that happens, profits go up and the whole thing changes again, and you'll see these stocks related to certain commodities take off. So that's why Goldman Sachs says a new bull cycle for commodities should emerge in 2021. Another interesting thing to look at, and could be once again another bullish factor for this market. Bitcoin update. We've talked about this before, but this Bitcoin monster bull cycle that's happening right now is driven by institutions and not retail. And that's important because, as I explained in the last video, institutions are much more likely to hold on to Bitcoin and not just trade it. They're steadier hands with way deeper pockets, so you're not likely to see the huge boom and bust that we had in 2017 when it came to Bitcoin. When we talk about institutions, we're talking about like banks and stuff, like huge groups, hedge funds. Even Druckenmiller, the legendary Stan Druckenmiller, market wizard, billionaire investor, he's holding some Bitcoin. And he explained it like this: Bitcoin could be an asset class that has a lot of attraction as a store of value to both millennials and the new West Coast money, Silicon Valley. And as you know, they got a lot of it. Yeah, they do have a lot of that money. It's been around 13 years, and with each passing day, it picks up more of its stabilization as a brand. So in 2017, when we were talking about Bitcoin, we were constantly talking about how volatile it was because it was crazy. It was all on speculation, right? But as time moves on, and we talked about this a few years ago, it will become more and more stable, especially these institutions get in and there's more technologies for blockchain. And that's what's happening right now. So in this new boom, you might not see that huge drop that we saw before, as I just explained. There's more stability, and you can even see it in the actual volatility of Bitcoin's price. The volatility relative to the S&P 500, which is stocks, has dropped to historical lows this year, meaning Bitcoin is becoming a lot less volatile when you're comparing it it to stocks. I'm not saying it's less volatile than stocks, but in comparison to what it was before, when you compare the two, it is becoming more and more stable, which is a good thing for long-term investors in Bitcoin and for it to become a legitimate market, which it is slowly becoming, if it isn't already. And one of the best parts about our reviews every week is the quote that comes with them. And this one is from Jim Paul in his book, What I Learned Losing $1 Million. He said, you can either play the system or you can let the system play you. I like playing the system because it's more fun and you win more. If you let the system play you, you can get very frustrated and very beat up. And this quote basically sums up everything we've been talking about in this video when I constantly say, instead of trying to play the market, play what actually influences the market, the person. So when you look at markets in that sense, everything looks a lot different and it makes a lot more sense too. So in our strategy that I always talk about on this channel, our Fallible Strategy, it's a momentum strategy. So what we're doing is finding the stocks that are moving higher the fastest, and we have an algorithm that does that and spits out a solid number that tells us how strong a stock is. Well, we're investing in that and we're not looking at anything else. Why? Because we know that regardless of what's happening fundamentally, people are buying these particular stocks for a reason. And what we're playing are those people buying, because what does it take to move a stock higher? It takes buying pressure. The price of your stock is only going higher because someone else wants it. So when we see that happening, we get into the stock regardless of what it is. Well, in our situation, it has to be in the NASDAQ. But the point being is that we're playing the system, and the system is people, but we're not getting played by it. We're not sitting here scratching our heads thinking, hey, why is this going up? It doesn't make sense. We should avoid it. No, we're more like, hey, it's going up. There's clearly something we don't know. Let's get in, because you can't know everything in the market. And that's where a lot of people get stuck. They're trying to understand every little thing when you can't. It's one of the most complex systems in the world. What you need to understand is your own strategy and how it works long term, and risk control. And then of course, like I was saying, your fellow investor. You put those things together and you can be very successful long term in the stock market. And as always, if you want to learn exactly how we do that so you can do it yourself, make sure you check out our free training. There's a link in this video and down below in the description and comments. And if you're interested in more of our research, one of the big trends we're tracking is AI. So I got a playlist of videos here about the stocks that we're looking at and how we analyze them. So if you want to jump on that trend with us, which is huge, make sure you check out this playlist. There's a link in this video down below in the description and comments. And actually on the very next screen here in a few seconds, you're going to see an option to click to that playlist. Definitely do that and continue with us. The training will be there too. So whichever option you go, make sure you're clicking and getting to this next video. You don't want to miss out. I'll see you there.